You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mark from The Moose on the Loose. I hope you're doing well. Today, I want to talk about recent trends. What do I mean by that? Well, I've been seeing a lot of chatters as of late regarding Enbridge and TC Energy and how they have been like thriving businesses, and it's like crazy that you're making so much money with those pipelines, and they have like solid balance sheet, they have an impressive business model, they work like toll booth because everybody use pipelines and then they have to pay to use it, and if they don't use it, well, they still have to pay, so it's like a cash flow making machine, and everything seems to be like perfect. And I'm not here to tell you that Enbridge and TC Energy are bad stocks. That's not my intention here. So do not go outside and say Mike hates those two companies. That's not what I'm saying. What I'm saying is maybe you should not get that excited about short-term price movement. So when you look at Enbridge and TRP, year to date, pretty impressive actually. They're both up about 20%, including their dividends. So their total return since the beginning of the year is about 20% each. In comparison, if you look at the XIU, which tracks the S&P, not the S&P, sorry, the TSX 60. The TSX 60 is up about 10%. So it's a double return for Enbridge and TC Energy. Definitely pulling the index up on this year, which is amazing. And I'm glad for all the investors that have those two great pipelines in their portfolio. And to be fair, both Enbridge and TC Energy show a long track of dividend growth history. They have a very stable business model. So TC Energy is more about natural gas pipeline. Mind you, they're going to split the company into two companies later on this year, so you have to follow up on that. You can look at I've done a video about this on my YouTube channel, so you can take a look at the dividend guy on YouTube, and you'll find the TC Energy split explanation. There's no dividend cut expected, so you're going to receive shares of both companies, and the total of both companies' dividend will be the same as it is being paid right now. So those are like, technically, this is what the management told us it's going to happen. So good news. For Enbridge, they are making more acquisition this year. And once they have completed it, they will become a 50% crude oil pipeline, 50% natural gas. So again, those two companies have very important assets. Similar to railroads, there's not many ways that you can move crude oil and natural gas without using pipelines. And same thing when you want to move a lot of goods, you'll use the train. Well, in this case, you're going to use the pipeline. Both companies have a very long-term contract as well. So all of those things are quite positive. Now, if they're that positive, can you explain to me that if you look at the past 3 years total return, we have about the same result. So Enbridge is slightly better, so it's up 33.5% versus 20% for year to date. But TC Energy is up like 21%, so pretty much in line with whatever David did. So the last 8 months have generated all the returns over the past 3 years, which is almost concerning. And it gets even worse when you take away the total return and just look at the price variation. So over the past 3 years, Enbridge just went up by 10%, which pretty much all happened recently. And for TC Energy, it's actually flat. So it went up and then it went down and then it's going back up. So what's my point here? Because I keep telling investors all the time, the stock price fluctuation doesn't matter. Total return does matter. Like, that's the only thing that is important. And I still believe that to this podcast as well. So why I'm making the difference between both is just to highlight that both companies should be treated more like deluxe bonds. So companies that you do not have a high expectation of stock price return. So the capital appreciation will be modest to be nice. and the dividend will actually generate the returns, which I have nothing against it, but just to understand what will be the role of those type of businesses in your portfolio, this is pretty much it. So you will have like stable businesses paying a high yield, getting a good income. So all of those things are great. So, and if you don't mind getting most of your returns in form of dividend, well, there you go. This is exactly the perfect match for you. So now, are Enbridge and TC Energy like going to keep on surging like this? Because like recent price movement is quite impressive, and it kind of like gives you the thinking that it's not over yet. Well, I'm sorry to break it, but this is where the problem is. When I look at a longer term graph, what I see is probably that in 2022, at the beginning of 22, both stocks went up very fast. And after that, what happened is that they went down very, very fast. So between June of 2022 all the way down to October of 23, that was just downhill almost all the time, going lower and lower and lower. And now we see some kind of like a recovery. So my point is, most of the time, the stock market will go a little bit crazy on both sides. So while the market got concerned a lot about Enbridge and TC Energy debt level and interest charges going up, so that kind of like depleted most of their stock price value at that time. Now they're getting back on track saying, oh, like Bank of Canada cut their rate twice. We're probably going to have like more rate cuts. And there's kind of like an interest towards the energy sector again. So here we go. We have that like reviving two stocks, recovering most of like the craziness that just happened. So on both sides, it was a bit too much. You know, like last week, we had Starbucks jumping by more than 20% overnight just because they changed their CEO. But Starbucks also dropped by 20% on bad earnings a few quarters ago. So just to show you how the market sometimes is just going crazy on both sides. I don't think the new CEO is going to completely revolutionize the business. So it brings like billions in market capitalization instantly. But at the same time, a bad quarter is not necessarily the end of the world. So going back to Enbridge and TC Energy, I just expect them to remain relatively stable. So those companies are not on fire. They're great and stable Deluxe bonds. They've been like this for a long time, and they're going to continue to be like this for a very long time as well. Keep in mind that both companies have reduced greatly their dividend growth rate policy. So Enbridge, not too long ago, was increasing its dividend by 10%. Now it's down to 3%. TC Energy was more in the like 4 to 5%, and now it's going back more closer to 3%. And going forward, I don't expect them to increase their payout by more than 3%, which is great because it's more than enough to cover inflation, especially now that inflation is slowing down. So definitely not a bad news, but do not look at a stock price chart for like a few months or a year and then determine if it's a good investment or not. That's just noise. Like either on one side or another. Like I would not tell you, oh, see, those two companies in 23, they were down like double digit and they're like very, very bad companies. I don't think so either. I've sold my shares of Enbridge at the beginning of 23, so pretty much at a very good price back then, and I made a good profit on it. But the reason why I sold was not because I didn't like the stock or anything like this. The reason I sold was it doesn't fit my investment strategy anymore. Like my thesis about Enbridge was first making a play on an undervalued stock that was like having troubles with regulators back in 2017. So that was a pretty good play. And after that, well, back then it was increasing its dividend by 10%. So I had like the best of both worlds with a stable business and an aggressive dividend growth rate. I just loved it. Fast forward to 23. Those are not the case anymore. So the price has gone up since I bought it. So I made some good money on profit. I had also a good dividend, but the dividend is slowing down and I had no interest at this point to hold another Deluxe bond in my portfolio. So having the explanation around the reason why you buy and why you sell a stock is more important than just looking at a stock price and determine, oh, this stock is up this year, it's an amazing company. Oh, this stock is down this year, it's a trash company. Do not fall into those easy shortcuts. That's just market noise. And over a longer period of time, you will see which kind of company will thrive. So just want to bring that to your attention. Again, I'm not saying that Enbridge and TC Energy are bad companies. They're definitely very stable, generating a lot of cash flow and rewarding shareholders, but you still must monitor them quarterly to ensure that everything is in place and they're not spending too much money on interest charges. All right, Moose, that's enough for today. We're going to talk again until tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.